We're climbing. It looks like it's going to be a good day, right? Okay, well, good afternoon and welcome to another Iowa Tax webinar. My name is Kyle Kugler and I am a program associate at the University of Northern Iowa's JPEC, John Papa John Entrepreneurial Center. And I'm also a part of the Iowa SourceLink team. Iowa SourceLink is a platform that provides information and makes connections for people looking to start and grow their businesses. It is produced through a partnership between UNI's JPEC as well as the Iowa Economic Development Authority. So today during our tax webinar, we are going to be covering pass-through entity updates. But before we get started, let's just go over a few housekeeping items. First off, this session is being recorded and will be available at a later date. This is typically within a day or two, so just be patient with us as we get that uploaded and available for you to view. The slides are also available for you to download at the link that Sophie, who is working in the background today, is posting for us in the chat box right about now. Please also, if you have questions, enter them into the Q&A chat box that should be located at the bottom of your screen. We're going to hold off on answering questions that come in until the very end of the webinar today. So just be patient. Maybe you'll find the answer to a question that you have throughout the presentation. But if you do have something, feel free to ask it. But yeah, that's basically it for the things that I'm supposed to say at the beginning, so everyone's on the same page, right? So presenting today is Mike Mertens and Kurt Connick at the Iowa Department of Revenue. Mike is a policy director for the pass-through entities, and Kurt is the policy director for individual income tax. And so with that, Mike, I'll let you get started.
All right. Thank you, Kyle. Can you hear me all right?
Yep, you're perfect.
Excellent. All right. Thank you for hosting this webinar and everybody that's attending. Thank you for sharing your lunch hour with us. As Kyle said, we're going to spend the next hour to hour and a half talking about a number of pass-through entity updates, income tax updates that have occurred over the last few years. My name is Mike Mertens. As Kyle said, I'm the policy director for pass-through entities. Kurt is also here to help when we go over go through some of the form redesigns that we're going to talk about. So let's dive right in. Before we do that though, our standard disclaimer, which is that this presentation is intended for general educational purposes only, should not be construed as legal advice, and we may take contrary position in the future to the one stated in this presentation. And of course, any oral or written opinion by the department that is not pursuant to a petition for declaratory order is not binding on the department. With that out of the way, we also have a slide here with the department's mission statement, vision, and values. I won't go over that in detail, but that is there if you'd like to read that later. So we have had a number of very important legislative and other changes that have occurred over the last few years specific to pass-through entity income tax. And we're going to try to discuss all of those today. Here's the list of what I hope to get through. First and foremost, I want to spend quite a bit of time talking about Iowa's new composite return requirements. From there, we'll roll into some discussion about new late file penalties and some new e-file mandate rules that were just enacted. The department also made significant changes and actually completely redesigned most of its pass-through income tax forms this year. So we want to spend a little bit of time hitting the high points of that form redesign and pointing out some new features or new changes to those tax forms. And finally, I hope if we have time, we're going to talk about some of the federal partnership audit changes that have occurred and how those partnership audit changes need to be reported to the state of Iowa. I'm getting a comment that it's hard to hear me. Let me see if I can zoom get a little closer to my computer. So yeah, if we have time, we'll discuss those federal partnership adjustments and how they need to be reported to the state of Iowa. And then we'll also talk about some new legislation that dictates how Iowa pass-through entity audits are to be conducted. So in 2021, during the 2021 legislative session, Senate File 608 made some substantial changes to Iowa composite returns. Many of you are probably familiar with Iowa's composite return and composite return system, which was traditionally filed on the 1040C. So this legislation completely changes the composite return requirements. So same name, but completely different form and system. So I want to spend quite a bit of time walking through each step of that new composite return system. First and foremost, these new composite return changes apply to tax years beginning on or after 2022. Let's just start with the fundamental threshold question, that is, who must actually file a composite return? So that is going to be any pass-through entity, which will be a partnership, S corporation, estate, or trust that meets any of the following that meets both of the following requirements for the tax year. So number one, the pass-through entity has to have Iowa source, or has to have an Iowa income tax filing requirement. And then second, if the pass-through entity has one or more non-resident members at any time during the tax year, if both of those requirements are met, the pass-through entity will be required to file a composite return. This new composite return requirement is mandatory. It is not elective as the old 1040C was. And again, like I stated, this applies to any pass-through entity tax year that begins on or after January 1st, 2022. A quick point about the mention of partnerships here. So the definition of partnership really includes any entity filing for federal or Iowa income tax purposes as a partnership. So this would include an LLC or other entity taxed as a partnership. So there are a few pass-through entities that are wholly exempt from the composite return filing requirement. First, publicly traded partnerships are exempt from the composite return filing requirement, provided they file their Iowa 1065s, 1065 and Iowa Schedules K1. So if they meet that filing requirement and report those, make that reporting to us, publicly traded partnerships are exempt from the composite return filing requirement. Also exempt is any pass-through entity that is only in the state of Iowa for purposes, temporarily for purposes of performing disaster or other emergency related work. This exemption is found in Iowa Code section 29C.24. So if they meet that limited income tax exemption because they're here to do disaster emergency related work, they are also exempt from the requirement to file a composite return for that tax year. And then finally, if there is any pass-through entity that is prohibited under federal or state law from making distributions to its members, they will also be exempt from the composite return filing requirement to the state of Iowa. So a pass-through entity is prohibited by law from making distributions. When that occurs, the exemption only applies to the tax year in which the distributions are prohibited by law. And another important point here is that contractual restrictions on distributions, such as those contained in loan covenants or other organizational documents, those don't qualify as a prohibition under law for making distributions. So it has to be a prohibition under either federal or state law to qualify for that filing exemption. So we mentioned non-resident members on the last slide. Who is a non-resident member? This is also a big change from the old composite return law, which generally only included non-resident individuals. So for the new composite return requirements, a non-resident member includes not only non-resident individuals, but also partnerships, S corporations, or C corporations without a commercial domicile in Iowa. It also includes estates or trusts without a situs in Iowa. Under Iowa law, commercial domicile is defined as the principal place from which the trade or business of the taxpayer is directed or managed. And then the determination of where a trust or estate is situs is actually a multi-factor test. It can depend on a number of things like the residency of the decedent, the type of trust you're dealing with, other factors, including but not limited to the residency of the trustees, location of the principal office where the trust is directed or administered, and sometimes the location of the trust assets. So I would invite you to look at Iowa Administrative Code 700.3 for more information about determining the situs of an estate or trust. This non-resident member determination is measured by the entire period of time that the person was a member during the past entity's tax year. So if you consider, for example, an individual who was a member of a past entity for an entire year, and so at some point during that year that member moved in or out of Iowa, under Iowa law, they would be considered a part-year resident, not a non-resident member, so they would be excluded from the composite return filing requirement. Another important thing to remember here in this non-resident member determination is that any partnership, or excuse me, any partner, shareholder, or beneficiary whose state of residence, commercial domicile, or situs is not known by the pastor entity shall be considered a non-resident member. So it's very important to keep those lines of communication open with your non-resident members or members who you suspect may be a non-resident member to be able to determine whether they need to be included on that composite return.
Hey, Mike.
Yes.
Quick dealio for you. We've had a couple people reach out saying that your audio keeps like tuning in and out. Are you like by chance using like an extra microphone, or is it just from your laptop that you're working on?
It's my laptop microphone. Yeah,
Microphone.
I could try calling in on my phone. Would that help?
If you'd like to, that's fine. Just as a reminder for everyone, if you are having a hard time hearing, we are going to be answering questions later on. So if there is something that you missed, feel free to ask later on as well. This will be recorded and available within a couple of days or so. So if there's something that you missed, feel free to watch back for the answers then. But yeah, Mike, if you want to try calling in, you can. I'm able to hear you. It just kind of cuts in and out a little bit.
Okay. Yeah, I don't know if I have the technological skills.
Sure.
Calling right now,
Sophie and I will work on the back end and try to figure that out. You just keep rocking and rolling, and
we'll try to.
We'll let you know.
Okay, I'll try to get a little bit closer to my computer.
Thanks,
here.
Mike.
Yeah, sure. So we've discussed who must file these composite returns. We've discussed who a non-resident member is for purposes of this composite return. The next question is, when is this composite return due? This is sort of a unique feature of the new composite return tax, because the return due date of the composite return is tied to and follows the due date of the pass-through entity's Iowa income tax return. So this includes extensions. Got a few examples here that I think would be good for us to go through together. The first here, let's take, for example, a partnership that is a calendar year filer. So their 2022 partnership return would be due on May 1st, 2023. Because the partnership doesn't owe any Iowa tax, because partnerships are pass-through entities, the partnership automatically qualifies for that 6-month extension to file its return in the state of Iowa. No extension request is required under Iowa law. So the partnership takes that extension by filing its 2022 partnership return on September 15th, which is after the original due date, which means its extended due date is October 31st, 2023. That would mean that the partnership's composite return for 2022 is also due on October 31st, 2023. Let's tweak that example ever so slightly to assume that the partnership files its 2022 partnership return on March 15th, 2023, which is before the original due date of its partnership return. By filing before the original due date, the partnership has not elected to take that automatic 6-month extension. Therefore, the partnership's 2022 composite return is due on May 1st, 2023. So this is this will take some getting used to track the composite return due date being tied to the pass-through entity's income tax returns. Late filing penalties do apply for filing a composite return late, but just a reminder, that could be the 5%. Those late file penalties are like other penalties under Iowa law, 5% of the unpaid composite tax. But there is a late file penalty exception if you pay at least 90% of the composite tax due by the original due date. So then let's talk about that composite tax due date, because the tax due date is different than the return due date. The pass-through entity's composite tax is always due by the original due date of the pass-through entity's income tax return, not including extensions. So let's do another variation on that example we just discussed. In this example, the partnership is still a calendar year filer, so its original due date of its 2022 partnership return would be May 1st, 2023. In this example, the partnership qualifies for and takes that automatic 6-month extension to file its partnership return by filing after the original due date. This also extends the composite return due date by that 6 months, but it does not extend the composite return tax payment deadline. Even though the composite return is due October 31st, the pass-through entity's composite tax must be paid by May 1st, the original due date of that composite return. Filing late can incur late pay penalties and interest. Again, those penalties there is an exception under Iowa law if you pay at least 90% of your composite tax due by the due date. Estimated composite, this is a question we've received several times. Are estimated tax payments required under the new composite return system? The answer is no. Estimated composite tax payments are not required under Iowa law. The entire balance due of composite tax is due on that original due date. There may be pass-through entities that desire to make prior payments, either for extension purposes to qualify for that 90% extension penalty waiver, or for a number of other reasons. If there is a need or desire of the pass-through entity to make an advanced payment of composite tax, those payments will be eligible to be made directly on GovConnect Iowa when we go live on November 14th. Either on the website itself, or you can use the website to print a payment voucher and pay on paper. If you need to make an advance payment before November 14th, when the new system goes live, the department's website guidance for the composite return does have a mailing address for where to make those payments.
Hey, Mike, I've got an update. So can we try and have you call in?
Sure.
On the left side of your screen is the mute button. There's like that little up arrow.
Okay.
There's like a switch. So if you click that little arrow, there's a switch to
phone audio.
Yeah, click that and try dialing in. I think it's probably just the first number that pops up. And then
I can do that.
You might have to type in the meeting ID and maybe the participant ID that shows up there. I'm not sure. But we should still be able to see you at that point and would hear you probably a little more clearly.
Sure. Yeah, I apologize for the audio.
No problem. I always say this, for as smart as technology is these days, it's pretty dumb most of the time, right?
People say that about me too.
We would never say that. Come on now.
How about
How about
this?
this? Is this better?
Yep, let's mute, hold on. Can you hear me now? Okay, now all right, I think we have you muted now. Let's,
Oh, here we go. Unmute. Is this better?
yep, I believe so.
Okay. Do I proceed?
Yes, absolutely. Thank you so much for doing that.
Excellent. Sure. The composite return itself is actually a fairly straightforward small return. It's about 2 pages long with an attached non-resident member schedule. That non-resident member schedule is the most important piece of the return because it's got most of the non-resident reporting on it. So I wanted to start with that non-resident member schedule. If you look at this schedule, you'll see most of it is fairly self-explanatory. For each non-resident member, you're gonna enter tax ID, name and address. You're gonna disclose the type of entity it is, whether it's an individual, a business entity, so on or so forth. You're also gonna record the ownership percentage in the pass-through entity for each non-resident member, I should say. I wanted to pause here on this exemption code because this is an important piece of the composite return. This is column F here. So there's a small handful of non-resident members who are exempt or excluded from the composite return tax payment requirement. And this is where you record those non-resident member exemptions here in column F. So publicly traded partnerships, if you are a pass-through entity with a non-resident member that is itself a publicly traded partnership, those entities are exempt from the composite return tax payment requirements. You would record that exemption here in column F. Tax exempt entities are also exempt from the payment requirement, obviously because in general, the Iowa source income received by those tax exempt entities will not be subject to Iowa tax. There's the exception here would be if some of that Iowa source income is itself subject to the Iowa unrelated business income tax. In that case, the exemption will not apply with respect to that income. Insurance companies qualify for a tax payment exemption under Iowa law because insurance companies generally pay the Iowa insurance premiums tax instead of the Iowa income taxes. And then another big piece of this is elections out of the composite return using this non-resident member composite agreement that the department developed and publicly posted on our website earlier this year. This non-resident member composite agreement allows a non-resident member to elect out of the tax payment requirement on the composite return. In order for it to be effective, the agreement needs to be signed by both the non-resident member and the pass-through entity prior to the composite return due date. All of these non-resident member agreements are not filed with the department, so there's no requirement to submit them to the department, but they do need to be kept with the pass-through entity's records because the department may request proof of those agreements in the future. Each non-resident member composite agreement is only applicable for one tax year. So if you have non-resident members who elect out of that composite return tax payment in 2022 and they desire to do the same thing next year in 2023, if they are still non-resident members, that non-resident member must execute another composite return, a non-resident member composite agreement for that tax year. Department does have the ability to revoke this ability of a pass-through entity or a non-resident member from electing out of the composite return tax payment requirement if there are issues with non-compliance. A very important note here, these exclusions that I've listed here, or this election out using this agreement, only applies to the composite tax payment for that non-resident member. The non-resident member still must be reported on the composite return, and that non-resident member's exemption code logged in the appropriate column. So if you have a particular non-resident member who has elected out or is otherwise exempt from the composite return tax payment requirement, for that non-resident member, you'd be filling out columns A through F, and then you would stop, and you would not need to fill out columns G, H, and I, which is really the composite tax calculation part of the non-resident member schedule. For all other non-resident members who are not exempt from or who have not elected out of the composite return tax payment requirement, you're going to be filling in columns A through I for each non-resident member. The composite tax payment calculation for each non-resident member is a very straightforward, simple calculation. You're going to take the Iowa source income with respect to that non-resident member from the Iowa K-1, multiply it by the applicable Iowa tax rate, and if it's greater than 0, then you owe Iowa composite tax for that non-resident member. The applicable Iowa tax rate is really the highest tax rate that is unique to that tax type. So individuals, a non-resident member who's an individual, for example, for 2022, you'd be multiplying their Iowa source income by 8.53%. Corporations, you'd use the 9.8% top corporate income tax rate. Under Iowa law, if the non-resident member is a partnership or an S corporation, you would use the highest individual tax rate. So you'd be multiplying those members' Iowa source income by 8.53%. Then another piece to point out here is if your non-resident member is a financial institution subject to the Iowa franchise tax, but it also happens to be organized as a pass-through entity, Iowa law says that you use the franchise tax rate in column H to determine that member's composite tax, not the individual income tax rate. So let's talk a little bit about how this Iowa source income for each non-resident member is calculated. And it's a fairly straightforward calculation. I've got a bit of a preview here. Here are the new 2022 partnership and 1041 K1s. I put these here to illustrate that the Iowa source income calculation for the composite return tax purposes is really a simple addition of certain fields on the K1. So if you're looking at a non-resident partner in a partnership, you're going to essentially add 3 lines from column B of the K1. These are the amounts of income attributable to Iowa. You just need to add the net income sourced to Iowa plus the Iowa source amount of the modifications, and if there is any non-business income that has been allocated to Iowa down here on line 19, column B, you'd add that. So it's really just the addition of 3 lines on the K1 gets you each partner's Iowa source income for the composite return tax purposes. The same calculation essentially applies to the S Corp K1, so I didn't list that here. Similarly, if you have a non-resident beneficiary of an estate or trust, the Iowa source income calculation is essentially just going to be the addition of part 2, lines 1 through 9 on the Iowa K1, which is in essence the Iowa source distributable net income attributable to that non-resident member. So you add those 9 lines up, and that is your Iowa source income for those non-resident beneficiaries. Again, those Iowa source income amounts get computed, listed on the non-resident member schedule. You calculate a composite tax due for each non-resident member. Couple things to mention here. There are no Tax credits are not claimed on the composite return, so there's no calculation made for Iowa tax credits. There are no other Iowa entity level adjustments made for partner level tax attributes. What I really mean here is if the partner happens to have a NOL carryover at the partner's level, those things don't factor into the composite return tax calculation. It is simply it is determined at the entity level using the Iowa source income on the K1 times that applicable rate. That gets you the tax due. If one member happens to have a loss allocated to them, that loss is not netted against any other non-resident member's composite tax due. So it's really a separate calculation for each non-resident member. After you've done that for each non-resident member, those total amounts of composite tax due are summed, and they flow through to the first line of the return, which is the total composite tax due. From there, it's a fairly simple return, which factors in any composite credits that the entity may be claiming, calculates prior payments, or factors in prior payments, calculates penalty and interest, and that is the sum and substance of the composite return starting in 2022. So what happens after composite tax is paid by the pass-through entity? Once that happens, each non-resident member will receive a refundable composite tax credit equal to their share of the composite tax paid by the pass-through entity. These composite credits are reported to the non-resident members on dedicated lines of the Iowa Schedules K1. Once those composite tax amounts are paid to the state of Iowa, they are treated as paid on behalf of the non-resident members. And what this really means is the pass-through entity cannot then request a refund of the composite tax paid on their non-resident member's behalf. Those refunds may only be requested by the non-resident member on their own Iowa income tax return. So how do the non-resident members actually claim their composite tax credit? For individuals and C corporations, it's fairly straightforward. Those amounts are going to be claimed directly on the 1040 or the 1120. If a partnership or an S corporation receives a composite tax credit as a non-resident member of another entity, those composite tax credits must be claimed on its composite return. So it could be that the non-resident member does not itself have a composite return filing requirement, but if it receives a composite credit from another entity, it may need to file a composite return only to claim that refundable credit that it is due. Estates and trusts are a little bit trickier. A fiduciary can claim a composite credit. It could split their total composite credit and claim it on either the 1041 or the Iowa composite return. Similarly, if a financial institution that is required to file an 1120F, if it receives a composite credit and it is itself organized as a pass-through entity, it can claim its composite credit either on its Iowa franchise return or on its composite return. If you look at the bottom of the screen here, these composite credit payments are taken into account. This is part of the composite return. The filing entity reports its total composite credits that it received, and then it backs out any composite credit that it claimed on either its franchise return or its 1041. So it's only claiming the net balance that it has remaining in those composite credits. Whenever a non-resident member receives a composite credit from another entity and is claiming that composite credit on one or more Iowa returns, it is required to report those amounts or provide a schedule of those composite credit amounts on a new form called the Iowa Schedule CC. This is really just a summary of all the composite tax credits received by the non-resident member during the tax year. or for the tax year. And it must be filed by the non-resident member with the applicable Iowa return when it's claiming that credit. This new Iowa Schedule CC is not used by pass-through entities to report composite credits to its members. As we discussed earlier, those composite credits are actually reported directly on the Iowa K-1s. So this Iowa Schedule CC is only going to be used when those non-resident members are themselves claiming the credit they received from the pass-through entity. So once a non-resident member is included on a composite return, the next question is, and it probably received a composite credit, the next question is, does that non-resident member need to file its own Iowa income tax return? And the answer depends on the type of entity that it is. So C corporations, S corporations, partnerships, and financial institutions are still required to file an Iowa income or franchise return as applicable, even if they are included on an Iowa composite return. Estates and trusts that are included on a composite return also are required to file an Iowa fiduciary income tax return unless that trust or estate's taxable income is below the filing threshold in Iowa Code Section 422.14. Individuals are treated a little bit differently under the new composite return law. So individuals are required to file an Iowa income tax return unless either of the following are true. Number one, the individual's income is below the filing threshold in 422.13, or even if their income is above that filing threshold, if all of the individual's Iowa source income was included on one or more composite returns, it is that non-resident member that is an individual will be exempt from filing an Iowa income tax return. However, they still may choose to file an Iowa income tax return if they want to claim their refundable composite tax credit. So nothing prohibits a non-resident member who has been included on a composite return, a non-resident member individual who has been included on a composite return from filing an Iowa income tax return. They may have a filing requirement regardless of their composite return inclusion, but even if they are exempt from filing an income tax return, again, they may choose to file that return to claim their composite tax credit. So as with any new law, there are some transition issues we need to talk about. So that we just went through in some detail the new composite return that takes effect for tax year 2022. That, of course, means that the old 1040C that used to be used under the old composite return law is being discontinued. So there will be one more final year 2022 1040C that is available for fiscal year filers to report income for a tax year that began in 2021 and ended in 2022. And that is really because the new composite return law is measured by the pass-through entity's tax year. The old composite return law, the 1040C, was measured by the majority of the owner's tax year for which they were filing. So if you take an example, let's take this example of partnership P. So this is a fiscal year filer with a tax year that runs from July 1st to June 30th. So a majority of the partnership's partners are individuals who file on a calendar year basis. So under the old composite return law, the partnership was required, if it chose to file a composite return, it was required to file that on a calendar year basis. That was the majority of its owner's tax year. So to facilitate this transition from the old composite return law to the new one, the partnership may file a 2022 1040C to report Iowa source income from that 2021 tax year. It started on July 1st, 2021 and ended on June 30th, 2022. May also need to file a 2022 composite return. So it may be filing two composite returns, but they are for different pools of income, different tax years, even though it's the same tax year on the return. The old composite return law, as you know, allowed tax credits Iowa non-refundable and refundable tax credits to be claimed by the composite filer. The new composite return will not include Iowa tax credits. Those tax credits must be claimed by the members on their own return. So the question is, what happens to those carry forward balances when the composite filer files its final 1040C and we transition to the new return? And the legislature accounted for that last session in House File 2552. They passed some legislation which allows the pass-through entity to allocate those non-refundable tax credit carry forward balances it has from its final 1040C to allocate those credits on its 2022 K1s to its owners in any manner it chooses. And then when those owners, it's essentially distributing those final year credits out. And then those owners who receive those carry forward tax credit balances on a K1s will be allowed to claim those for any remaining tax years, carry forward years that the pass-through entity itself could have claimed them on the 1040C. Finally, there are a number of pass-through entities who may have a short tax year in 2022, a tax year that began in 2022, so they're subject to the new composite return law, but their tax year ended before a normal 12-month tax filing period. They may have a due date for the composite return before the original sort of normal 12-year filing period, which would be due on May 1st, 2023. The department has not released the official new composite return form yet. So in order to relieve those pass-through entities of incurring any sort of late file penalties for a return that was not available yet, the director issued order 2022-02 earlier this year, which extends short year composite filing deadline to May 1st, 2023. So for any short year tax year filer, the composite return will be due, that short year composite return, will be due May 1st, 2023. There will be no late filing penalty assessed as long as that composite return is filed by May 1st, 2023. This composite return extension does not extend the income tax filing deadline, nor does it extend the composite return tax payment deadline. Late pay penalties and interest may apply. The department's website guidance, which has been up since the beginning of this year, has instructions for how to make those payments prior to the composite return filing deadline, if you need to make those. Beginning on November 14th, when we go live, you will be able to make those payments directly on GovConnect Iowa, or to print off vouchers on GovConnect Iowa to make those payments. And finally, one more transition issue. With the enactment of this new composite return law, the legislature also repealed the non-resident member withholding requirement on pass-through income. So partnerships and S corporations and estates and trusts will no longer be required to withhold on their non-resident members' distributions during the tax year, because that tax payment requirement has been replaced with the new composite return tax. There may still be income withholding required for certain non-wage income paid to non-residents outside of the pass-through entity context, but I wanted to point out that the traditional non-resident member withholding has been repealed for pass-through entities starting in tax year 2022. All right, let's switch gears a little bit here, talk about new late file penalties that apply to pass-through entities. This is another very big change that was enacted a few years ago, and it takes effect starting in tax year 2022. So this will affect the upcoming filing season. And the new law imposes new late file penalties on partnerships and S corporations that file their return late. The traditional late file penalties under Iowa law were always a percentage of the tax due. Partnerships never owe tax due with the return. S corporations rarely owe tax due with the return. So traditionally, those late file penalties, even if imposed, were usually zero. That will no longer be the case. There is a new late file penalty that is equal to 5% of a partnership or S corporation's imputed Iowa liability. That is defined under Iowa law to essentially be the amount. What the penalty calculation essentially does is it takes the pass-through entity's Iowa source income, multiplies it by an imputed tax rate, which will be the highest tax rate for that tax type. Partnerships and S corporations use the individual rate, and then it multiplies that imputed tax by 5%. That gets you a 5% late file penalty, which is meant to mirror or replicate what the entity would owe in a late file penalty if it owed Iowa tax. There is a penalty ceiling and a penalty floor, so the maximum amount that will be imposed in late file penalties is $25,000. The minimum is $200. There are higher penalties in the cases of fraud or willful failure to file. So this is such a new concept. I think going through quickly an example would be helpful. In this example, Partnership P is a calendar year filer. It has $500,000 of net ordinary business income during tax year 2022. It has no other distributive income or deductions, and it earns no Iowa tax credits. So, and of course, this partnership is only doing business in Iowa. It has 100% Iowa apportionment factor. So this partnership files its return late. It does qualify for the automatic extension, but it doesn't file within that period. In this example, let's say it files late on December 1st, 2023. Because it's filed late, it is subject to that new late file penalty that I just discussed. And when you run that penalty through those income amounts through that penalty calculation, what you get is an imputed Iowa tax of $42,650. Then you multiply that by the 5% penalty rate, and you would get a penalty of $2,132.50 imposed on this partnership for filing late in Iowa. So this is a big change. I want to make sure everybody's aware that that pass-through entities could be incurring some significant late file penalties going forward if they file late. You could envision here that the partnership has a loss for the year. So if it incurred a large loss attributable to Iowa, and it filed late, it would still incur that floor, that $200 penalty. That's the minimum amount that will be imposed upon the partnership for filing late. This new late file penalty does not apply to estates or trusts. It does not apply to individuals, and it does also apply to corporate filers and franchise filers, but I just want to point that out, even though that's outside the scope of this presentation. All right, e-file mandate. Last session, legislature enacted an e-file mandate for certain business income returns. Again, this e-file mandate I'm about to discuss does not apply to individual filers. Partnerships and S corporations will be required to e-file their partnership or S corporation return, including K-1s, for tax years ending on or after December 31st, 2022, if the statutory threshold is met. So for most filers, this will kick in for their 2022 tax filing. There's a bit of a delayed effective date for trusts and estates. They will be required to file the 1041 for tax years ending on or after December 31st, 2023. So really that takes effect next year for those filers. The e-file threshold is $250,000 in gross receipts or $25,000 of Iowa credits reported on the return, or if the pass-through entity is required to issue 10 or more Iowa K-1s for the tax year. So if any of those three requirements is met, the pass-through entity will be required to e-file its return starting in tax year 2022. The department has proposed rules that have been adopted and will be published in late November. If you'd like to read those before they make their way into the administrative code, it is ARC. The way to locate those is ARC 6539C. You can search for that on the Iowa legislative website to see the rules. These rules are important for a number of reasons. They provide a definition of total gross receipts for purposes of the e-file mandate. And they also provide a number of other pieces of information that I've listed here. So impacted returns that are not e-filed will be considered invalid. What that means is the department will treat you as a non-filer. You may incur late file or other penalties. And of course, if you're a non-filer, the department has an unlimited statute of limitations to assess. There are exceptions to the e-file mandate, and the department is working on a new form that will be released in the not too distant future, which describes how to apply. That form will be used to apply for an e-file exception, and it will describe the types of good cause that qualify for the exception. Inadequate tax preparation software is not going to be considered a good cause. That's very important here. This new exception form must be submitted, will be required to be submitted before your return is filed. And the department will then review that exception request and notify the taxpayer in writing of its approval or denial. If you submit that request to the department and the department does not respond within 90 days, that request will be deemed accepted, and you will have for that tax year an e-file exception. And then there is some temporary one-time relief that the rules provide for tax years 2022 and 2023. If a taxpayer improperly paper files a return and we determine that you were subject to the new e-file mandate, we will notify you in writing, and you will have 30 days from the date of that notification to e-file your return. And if you do that properly, then the department will consider your original paper file return a valid return on the day you paper filed. All right, so we have less time left than I thought we would. So I did want to touch on a few form redesign issues, not issues, but I wanted to explain some of the new features of the new pass-through entity tax forms, because we completely redesigned the partnership, the S corporation, and the 1041 forms for tax year 2022. I don't want to go in depth about the calculations or the makeup of those forms. I just want to hit some of the high points so you have you have some familiarity with these new forms when you start reviewing them when they're released. First thing you'll probably notice for I'm going to go through some of the 1065 and 1120S changes, and then Kurt's going to touch on some of the 1041 changes. The first thing you'll notice is that there is more of a breakdown required of income and deductions on the main return. The Schedule K income items are no longer summed on line 1 of the return, so there'll be some additional reporting as you work through that main part of the return. Another thing you'll notice is there's a new Schedule A to report Iowa additions and reductions. So there's some more specificity on the types of additions and reductions that are available under Iowa law as you fill out the return. Starting in 2022, the partnership and S Corp returns will incorporate the Schedule D that probably many of you are familiar with using if you file 1120 returns. So the new returns will incorporate this Schedule D to report and allocate non-business income that the pass-through entity might have. The old 1120S had a single line to report built-in gains or passive investment tax that the S corporation might be subject to in Iowa. The new returns have some more specific reporting and calculations for that built-in gains and passive investment tax. So it will do a more complete job of walking the taxpayer through that calculation and calculating that entity level tax. There's also some additional lines on the returns starting in 2022 for tax, penalty, and interest. This will also include check boxes for reporting amounts due pursuant to an election to pay following a federal or Iowa audit, which we'll talk about here in a few minutes. And then we just talked about that new late file penalty that partnerships and S corporations could be subject to. The 2022 returns will have a worksheet directly on the return to calculate that late file penalty if it's applicable to that entity. Historically, pass-through entities did not report Iowa tax credits that they earned or received from another entity directly on the return. Those Iowa tax credits were passed straight through to on the K-1s and reported to the owners on the K-1s. Next year, this 2022 return, pass-through entities will also be reporting their Iowa tax credits for the year directly on the return. In addition to the K-1s, there's a new Schedule B we have implemented to facilitate that reporting. We also implemented a new Iowa Schedule K, which will not look unfamiliar to anybody that deals with federal returns. This Schedule K is intended to provide additional information to the department about the distributive income deductions and Iowa adjustments of the entity and how those amounts are allocated and apportioned within and without Iowa. This Schedule K also provides a summary of the composite tax, the total composite tax paid for all its members with the composite tax return. And then finally, there's a new look to the Iowa Schedules K-1 for both partnership and S corporation. I've only posted the partnership here, but S corporation looks very similar. You'll see there's a new Part 3 for reporting the composite tax for that non-resident member. There's some specific reporting for Iowa non-business income that it's allocated to Iowa for that particular partner or shareholder. And then the AMT items that were traditionally part of the main K-1 have been moved to a separate part. Keep in mind that this will be the last year for individual. This is only used in the case of individuals or estates or trusts. There is one more year of AMT tax in Iowa that will be phased out starting in 2023. So this Part 5 will probably most likely go away or be removed from the K-1s next year. So I am going to hand it over to Kurt to spend a few minutes talking about the 1041 notable changes. Kurt,
right,
let
Mike,
me know whenever you want me to move forward.
Okay, you probably need a cool drink of water after all that talking. I'm going to talk a little bit about the 1041 returns. There's been a dramatic change to the layout of the form, and I just want to walk through that so you have a chance to see this 1041 before you start preparing tax returns for this year. The top section that you can see in the left portion of the slide is pretty much the same. We're still collecting the same name information. We're collecting the type of return information. Important things I want to point out for those wanting certificates of acquittance, make sure that the boxes are checked for the final return and that a tax certificate of acquittance is requested. That's the most common reason why one of those are not issued. But something brand new appears on the right hand of the screen, and these are the questions related to the composite return requirements that Mike was just going through. And this helps you and the department identify whether there was a beneficiary that was a non-resident individual, or it could have been a trust or a state that had situs outside of Iowa, and same thing with S corporations and partnerships. So those are the questions that are going to help us identify whether that composite return requirement is required. And then question 5 just helps us understand whether the estate or trust itself received a composite credit that will be reported on this tax return. And then if I turn to page 2, Mike, if you want to switch that to page 2. Okay, and then on page 2, this has the power of attorney and the disclosure designee. This is on our current 1041 form, but I do want to remind people that power of attorney authorization is really exactly the same thing as the attorney information that we asked for on the old 1041 form. So if somebody wants a certificate of acquittance, make sure you complete this power of attorney section. It seems like there's a lot of confusion with that. And then on the right side is the designation for tax disclosure information. You would list somebody on that if you want somebody to have the ability to contact the department to discuss the status of a return or the status of that certificate of acquittance. But I just wanted to clarify that again. And Mike, we can go ahead and roll to slide 3. Okay, and here's the flow of the number section of the 1041 return. Over on the left hand of the screen, that's going to be information that you pull directly from the federal return. So that's easy peasy. You get all the way down to line 18 and you come up with your federal adjusted total income amount, which should match the federal return. And then up at the top of the bottom of the right hand page, that's where we make our Iowa net modifications, interest, dividends, depreciation adjustments. All those are going to be captured on one line. And then down on line 30, we added a new line for the tax related to the electing small business trust. And the calculation for that is going to be found on Schedule E, which we'll get to in just a little bit. So everything is similar, but we thought it'd be easy if we just pulled information off the federal return, made adjustments, and went on. And let's go ahead and roll to page 4 of the return. And this just continues on with the calculation of the tax, the application of any estimates that are paid. Line 41 is where you're going to report any composite return credits that were received by the trust or the estate. And then the rest of the form continues on the same as our 1041 form has in prior years. If we roll ahead to page 5, here's the schedule where we're going to report the modifications that were reported up on line 18. So part 1, that's going to be the additions. Those will be additions for interest, dividends. You'll add back the taxable federal refunds that were deducted. And then over on part 2, that's where we take the deductions for federal taxes paid, adjustments for dividends and interest, depreciation adjustments. So this is the page where all your modifications are going to appear. And then they'll carry forward to, well, I guess it's line 19. Line 18 was the federal adjusted total income. Line 19 is the modifications. And let's jump ahead to page 6. In the past, we didn't have a page to calculate distributable net income on the 1041. We borrowed the calculation from the federal return. So if you're familiar with the federal calculation of DNI, you're going to do exactly the same thing for Iowa purposes, but there'll be Iowa modifications when you're calculating the amount of Iowa distributable net income. And then we'll jump ahead to page 7. Page 7, there really isn't anything to discuss here. We copied the existing form that we had in our current 1041 for the computation of the non-resident part-year resident tax credit. Nothing changed on this form, but right now you just have one big continuous form, which I thought was helpful rather than having to go identify which schedules you needed to complete the 1041 correctly. It's all in one place. And then we're going to jump ahead to page 8. And the calculation for the Iowa alternative minimum tax, same thing. Rather than being a separate schedule, it's all on the Iowa 1041 this year. So nothing to discuss because this is exactly the same as it was in prior years. Okay, on line 9, if you've got a trust or estate that was an electing small business trust. Here's where we do the calculation, determine the amount of Iowa taxable income for ESBT purposes and calculate the tax. If you make the election, you essentially treat the ESBT portion as a separate trust, and you do a tax calculation separately. So this is where you're going to do that. The bottom section, if the trust or estate is a non-resident or part-year resident, you'll calculate that non-resident part-year resident credit here. And then finally, we've got the signature page, which is similar to what it has been in the past. So a lot of changes to the 1041. This will bring you to the bottom of it, but all the forms are going to be in one place to submit it. The only additional form is found on the next page, and that's our K1 form. Iowa has never had an official Iowa K1, and I know a lot of vendors created their version of the Iowa K1. And Mike gave you a sneak peek of this earlier. The information on the left-hand side, name, address, I guess all on the left-hand side really just has the basic information about the beneficiary and the name of the trust. But part one is important. When somebody prepares an Iowa 1041 form, or if they're a beneficiary of a trust or estate and they receive a federal K1, they're going to report all that income on the Iowa 1040, and then part one just reports that beneficiary share of the Iowa modifications. So there's going to be an adjustment on line 14 or line 24, which we hope is easy for the individuals and the tax preparers by just making one adjustment. And then Mike indicated earlier that on the right-hand page, section part two, that information is going to have a dual purpose. One, it's going to be used to calculate the amount of composite tax for a non-resident beneficiary, plus the same information is going to be used when that non-resident beneficiary completes the Iowa 126 form to calculate the non-resident or part-year resident credit on the 1040. And then in the bottom sections, you can see if you've got other credits, we're going to collect information on that in that supplemental section. If there's any Iowa withholding that passes out, we'll capture that. And then at the very bottom, that's where you report the amount of Iowa composite tax that was paid on behalf of this beneficiary. And Mike, I think those are all the 1041 forms. If people have questions, drop those in the chat box and I'll try to get those answered.
Very good. Thanks, Kurt.
Awesome. Well, yeah, as we discussed a little bit before we started this whole presentation, Mike, Kurt, if you guys want to.
Sorry, Kyle. Kyle, sorry, I have a few more slides to go through.
Oh my gosh, you have more. Okay. I apologize.
That's all right.
I'll mute myself and take
I'll try to get, we've actually got quite a bit left to go through. I'll try to get through it in the roughly 12 minutes we have left, 22 minutes.
Sounds great.
I want to spend a little bit of time talking about federal partnership adjustments. So I think most of you are probably familiar with, back in 2015, I believe, Congress passed what was called the Bipartisan Budget Act, which radically changed how the IRS resolves partnership return issues, both for amended returns and federal audits. So this caused all of the states to go back to the drawing board essentially and have to rethink how those partnership adjustments need to be reported to the states. The Multi-State Tax Commission developed a model act several years ago that Iowa did in substantial but not identical form enact a few years ago. And this model act, or these new legislative provisions, dictate how partnerships and their owners have to report federal partnership adjustments to the state of Iowa. So this new Bipartisan Budget Act, these are usually called BBA partnerships for short, or BBA audits. This applies to most, but not all partnerships. So the slides I'm going to talk about really reflect how adjustments for these BBA partnerships need to be reported to the state of Iowa. So this affects, again, like I said, both audits and amended returns. I want to start by talking about amended returns. Under the Bipartisan Budget Act, partnerships are generally not going to be filing amended returns in the future. Instead, they file something called an administrative adjustment request. These are resolved a little bit differently than amended returns. When a partnership files an administrative adjustment request, all of those adjustments are determined at the entity level. If there is additional tax due from that administrative adjustment request, it's called an imputed underpayment. That tax is generally paid directly by the partnership, or it can be what's called pushed out to partners. And then those partners pay those additional tax amounts with their current year tax return. Adjustments that amended return or administrative adjustment request adjustments that do not result in an imputed underpayment are generally pushed out to the partners, and they're eligible for a credit with their current year tax return. This is very complicated at the federal level, and this is not the forum to go through those changes and those procedures in depth. But what is important here is when partnerships these BBA partnerships file administrative adjustment requests, it usually results in their partners not having to file amended federal returns to reflect those adjustments. However, under Iowa law, those adjustments still need to be reported to the state of Iowa. So if you have an AAR adjustment that affects Iowa income tax liability or Iowa income, Iowa law says that those adjustments must be reported by the partnership and its direct and indirect partners on amended returns and amended K-1s. So again, this is true even if the partners are not required to file federal amended returns or required to pay additional federal tax. So that's a big change. These amended Iowa returns must include relevant federal documentation about or forms related to that AAR, and our website guidance, which is actually hyperlinked on this slide, provides additional details about those types of forms that must be submitted with the partnership and partners amended return. If the partnership or one of the tiered partners of the partnership, which really means a partnership, an entity that is its owner of a partnership and is itself a pass-through entity, if those entities had composite return or partnership withholding requirements with its original return, it may be required to amend those with their Iowa tax filings. So when do these things need to occur? Once a partnership files an administrative adjustment request, when do those changes need to be reported to Iowa? So the partnership has 90 days from the date of the federal AAR to file an amended return and issue amended K-1s. Those direct partners in the partnership have 180 days. They get an additional 90 days from the date of that federal AAR to incorporate those Iowa K-1 changes and file an amended return. If you have any indirect partners, which would be a partner who owns an interest in a partnership through one or more tiered entities, so we're really talking about a tiered structure with several pass-through entities involved. Those indirect partners have 90 days, need to file their Iowa amended returns within 90 days of the extended due date of the federal partnership return for the year, for the partnership that filed the AAR in the year the AAR was filed. So that that initial 90-day and 180-day clock is fairly easy to measure. It gets fairly complicated once you involve indirect partners in these reporting requirements. Filing a federal AAR does not extend the statute of limitations for requesting a refund under Iowa law, but it does extend the assessment period for the department. The department has an additional 1-year period to assess Iowa tax from the date that a complete amended return is filed by each partner in partnership. So if that's important to keep in mind, because if the partnership and the partners do not properly report those changes to Iowa, that additional statute of limitation period is unlimited for us to assess tax related to those federal AAR changes. The department does share information with the IRS, so we do get information about these amended returns. And if the entities and the partners do not properly amend, they could get a tax bill from the department in the future once we learn about that. So let's then shift to talk about partnership audits, which are even more complicated than partnership AARs. A BBA partnership that is audited by the IRS at the federal level, those adjustments are all determined at the entity level. Once the audit is complete and the IRS has determined any adjustments to the partnership's return, it starts this statutory modification period during which certain partners could amend their returns or participate in this alternative pull-in procedure, which is really just a substitute for filing an amended federal return. What this modification period really does is pulls out some partners' tax adjustments from the partnership. Those partners pay the tax they owe, and then those amounts are removed from the imputed underpayment penalty that the partnership or that the IRS calculated. After that modification period is done, the imputed underpayment, if there is one, is either paid by the partnership or it's pushed out to its partners, and those partners pay those amounts with their current year tax return. If the audit adjustments do not result in an imputed underpayment, those adjustments are either pushed out to the partners and they get essentially a non-refundable credit on their current year return, or they might be allocated by the partnership on the current year K1s to those partners, which would entitle those partners to an additional deduction on their tax returns. So under Iowa law, if there is this allocation of adjustments that are not imputed underpayments, those amounts must be added back on the current year returns to prevent a double Iowa deduction, and that is because the way the reporting works for Iowa is those partners are required to amend their prior year returns affected by the audit, and they could claim that tax benefit, those additional deductions on their amended return. So we can't have the partnership taking the same deduction in two different tax years, so those must be added back. Again, why this becomes complicated is because except for that modification period that I described above, most of the time direct and indirect partners are not going to be required to file amended federal returns to reflect those audit adjustments. However, they must be reported to the state of Iowa. A quick note on that modification process I described before the imputed underpayment is finalized. When that occurs, when those partners file amended federal returns or they participate in that pull-in process, under Iowa law, those are treated like federal amended returns, not as audit adjustments. So those particular partners, if Iowa tax or Iowa liability is affected, must file their own Iowa income tax return as if they were reporting a federal amended return adjustment. Department has an additional 1 year to assess tax related to those filings, just like I discussed for the federal AAR adjustments. So of course that means the assessment period is unlimited if you don't properly report them to the state of Iowa. For all other partnership audit adjustments related to these centralized BBA audits, if the audit adjustments affect Iowa tax or Iowa income of the partnership or the partners, Iowa law requires that those changes be reported by the partnership and all of its direct and indirect partners after the final determination date of the audit. Again, this is true even if the partners weren't required to file federal amended returns or pay additional federal tax individually. So the final determination date of the federal audit is defined as the date on which all appeal rights for all adjustments related to the federal partnership audit have been waived or exhausted by the partnership. So it's really the date when all of the adjustments related to the partnership audit have been finalized and by the IRS and the taxpayer and are no longer subject to any further appeal. There is another facet of these federal audit reporting requirements, and that is it incorporates this idea of an election to pay on its owner's behalf. The audited partnership, or if not made by the audited partnership, one of the tiered partners that is itself a pass-through entity, can elect to pay on its owner's behalf the tax related to those audit adjustments when reporting them to the state of Iowa. So how does this actually work? It depends on which taxpayer you are. If you are the audited partnership, you have to do one of the following within 90 days of the final determination date of that audit. You must either file an amended Iowa partnership return, including K-1s, and including any composite return or partner withholding reports that need to be amended, or you need to file an amended partnership return without Iowa K-1s and make that election to pay on your owner's behalf and pay that tax penalty and interest that's due from the federal audit. If the partnership makes that election to pay, that stops the reporting. Again, no amended K-1s have been issued. The partners of that partnership, direct or indirect, have no further filing requirement with the state of Iowa. If the audited partnership has not made that election to pay, the direct partners have a reporting requirement. So they must then, within 180 days of that final determination date, file amended returns and pay the tax due. If they are a tiered partner, that is, they're a pass-through entity, and the audited partnership has not made an election to pay, those tiered partners can make an election to pay related to their share of the audit adjustments. And it works the same way as the audited partnership does. So if they make that election to pay, they would file an amended return without amended K-1s, make that election to pay the amount due, and that ends the reporting to the state of Iowa. So let's talk a little bit about how, well, before we move to the election to pay, I want to just talk about what's required with these reportings. Amended Iowa returns must include certain federal documents or forms related to that federal audit. Our website guidance has additional information about what type of forms must be submitted with the Iowa amended return. If the audit results in a refund to the partnership or a partner, Iowa law does give the taxpayer an additional 1 year from that final determination date of the audit to request a refund of Iowa tax related to the audit. If the audit results in additional tax due, the department has an additional 1 year to assess that tax from the date that a complete Iowa amended return is filed by the taxpayer. Again, if the taxpayer does not report the changes and does not file an amended return, that statute of limitations is unlimited. And there's also an underpayment penalty exclusion. The taxpayer can avoid underpayment penalties to the state of Iowa if they properly amend and pay their audit adjustment, pay the additional tax due by those reporting deadlines I just described. So let's talk very briefly about that election to pay. So the election to pay is made on the Iowa 103 pass-through audit election to pay schedule. The election to pay can only be made by the pass-through representative, which we'll talk about here in a moment. When made, it's irrevocable. An important point here is that it only applies to federal partnership or Iowa pass-through entity audit adjustments. This is not what's traditionally called a SALT cap workaround. Iowa does not have one of those optional entity level taxes that several states have. This election to pay on the 103 is only related to audit adjustments from a federal partnership audit or an Iowa pass-through entity audit. When the entity makes that election to pay, all the owners must be included on the election to pay, even those that were originally reported on a composite return. As I said, the election to pay is made on the 103. Very, very briefly, this is very high level. How is that election to pay tax calculated? That tax calculation is dictated by Iowa statute, and it essentially runs the adjustments through there's three different defined categories of adjustments that could be included on an election to pay. So you could have income or loss adjustments related to the entity's base income. There could be Iowa tax credit adjustments, and then there could be Iowa apportionment adjustments. For tax credits, the calculation is fairly simple. It's a one-step calculation. If you have to pay back an Iowa tax, you add that amount back, the full amount back on the return. The calculation for income or apportionment adjustments is a little bit more involved. Essentially, what the return or this Iowa 103 does is it calculates the total adjustment that is from the audit. Then it allocates those adjustments into different buckets based on the ownership types. And that's important because each different ownership type has a different tax rate applied to it. So once you allocate those adjustments to the proper ownership types, the buckets, then you would calculate the tax for each one of those ownership types by multiplying it by the highest Iowa tax rate applicable to that tax type. Sum all those amounts together, and if the amount is positive, you are eligible to make an election to pay to the state of Iowa. Penalty and interest also apply to that election to pay. If you're submitting this form before tax year 2022, this is actually a process difference that we just changed. If you're going to submit this 103 and make an election to pay before 2022, you would submit it. You would submit the Iowa 103 separately from the amended return. The pass-through representative must sign that 103 and submit it separately from the return. Penalty and interest is calculated right on the 103. For tax years 2022 and later, penalty and interest is calculated directly on the return, not the 103. The pass-through representative does not need to sign the 103. That is because the 103 will be submitted as a schedule with the Iowa amended return. So that is just a process difference depending on tax years before 2022 or 2022 and later if you're making an election to pay. 103 also needs to include the schedule of all the owners and the adjustment amounts allocated to each one of those owners. 2 minutes is not enough time to talk about pass-through entity audits, but I will give it my best shot. A few years ago, the Iowa legislature changed the way that the Department of Revenue administers audits of pass-through entities. Essentially, in a nutshell, what it says is that audits of pass-through entities must be conducted and determined solely at the entity level. These audits will be conducted through the Iowa pass-through representative that is designated on that pass-through entity's return. So owners have no inherent right to intervene or participate in that audit, and the owners are bound by the results of that audit. This applies to all partnerships, all S corporations, and all estates or trusts. There's no owner threshold or election out like there is at the federal level. But what happens if you are subject to an Iowa pass-through audit? There are essentially statute of limitations related to that. The department must review and adjust the return within the applicable statute of limitations for other income tax types. So that's typically 3 years. And then on the flip side of that, the pass-through entity is generally restricted from filing an amended return after 3 years. If you get one of these, if you're subject to one of these audits, you might get, and the department makes adjustments to the return, you might get one of these final notices of adjustments directly to the entity. Owners will not initially receive tax bills, nor will they be required or allowed to file appeals. Only the pass-through entity, through its pass-through representative, can file an appeal. They also may receive additional tax due under other provisions of Iowa law.
Hey, Mike.
So
I think we're going to have to cut you off there. We're running out of time. That's here.
Fine.
I have written up a little spiel. Hopefully I kind of answer some questions that I'm sure people have that have been reaching out to us. So just be listening. Don't tune out just yet. I'm sure I'll share some information that you will appreciate. So I just want to say thank you again to Mike and Kurt for sharing the pass-through entity updates with us today. As a reminder, this webinar was recorded and will be emailed out to you in the coming days. It will also be available at the link Sophie will be sharing with you in the chat box right now. A PDF version of the slide deck is also available on this page. If your questions were not answered today, make sure to download the presentation as you may find your answer there, or rewatch this presentation for clarification. Additionally, all questions that were not answered today will be emailed to both Mike and Kurt so they can follow up with you. They'll have your contact information, so don't worry about that. The next department webinar will be on December 14th from 12 to 1 p.m. Central Standard Time. That webinar's topic will be electronic submission of W-2s and 1099. So get that on your calendar if that is relevant to you. So until next time, take care, everyone, and have a great rest of your day.
Thank you.
Mike. Thanks, Kurt.